welcome to the Conquer Risk podcast today. My name is Jeff Goodnow. Of course, I'm one of the norms on here, but I'm excited because about once a quarter, we like to do an interview of a portfolio manager or CIO, that sort of thing, from one of the strategists that's available on our Union UMA. So today we have Ethan Powell. Welcome to our podcast, the Conquer Risk podcast. It's a good deal. We've just started doing business together, and it's been exciting to learn. Of course, my responsibility, right? OCIO, go through due diligence. But part of the process here is to slow things down a bit and to allow advisors the opportunity to have some of the interaction that you and I have as we learn about the firm. Because one of the downsides of being an advisor on a multi-strategist TAMP is typically you get a performance filter, right? You don't get OCIO capabilities or assistance. You don't get to talk to the portfolio management team, and that's one of the things we see very important is the transparency. So on that note, welcome, Ethan.
Great to be here, Jeff. Thank you for having us.
Yeah, absolutely. So a couple of things that we want to make sure, sort of disclosure. We don't talk about price, platform, or performance here because those things are better left to have a one-on-one discussion about your specific needs, etc., right? All that blah, blah fun stuff. But we're going to go through some of the firm CPR process I'm going to ask some of the questions. We'll see where it goes. But Brookmont, help us out here. I know Brookmont Capital is available on, of course, Envestnet and some of these other places, again, like Union UMA. Tell us a little bit just basically about your firm. Who the heck is Brookmont?
It's a great question. It's funny because it's hard to talk about the firm without talking about performance because that's really, I think, our bread and butter. But I'll do my best for you, Jeff. Stay true to the mission.
There you go.
We were founded in 2007. I was introduced to Brookmont in 2010. I was actually working at a large Dallas-based hedge fund, and we were running about $40 billion. And we hired Brookmont to run our long-only domestic large-cap value strategies. And I think it's important to mention that because, and this is tangentially performance-related, so I apologize, but if you look at what they were doing, and we still have an upside capture of roughly 93% and a downside capture of 62%. And why that's meaningful from a hedge fund perspective is hedge funds are always coming up with these really creative ways with really, really smart people of participating the upside, limiting the downside, and we had actually never seen a risk return profile in a hedge fund strategy that was trading traditional liquid equities that had that 30% upside capture, downside capture ratio, right? So it was a positive 30%. But anyway, I think that's core to who we are. And Jeff, we accomplished that really in relatively simplistic portfolio construction and investment philosophy, right? We low turnover, we're roughly 15% turnover in any given year. Long time horizons, 3 to 5 year time horizons or longer. And most importantly, we invest in strong and sustainable dividend paying quality domestic equity companies. And that's really the crux of it.
Okay, so let's unwrap this a little bit. So tell us how many portfolio managers or how many are on the investment committee team?
So we've got 6 that participate on the investment committee team. So we've been running the same strategy in Brookmont for over 13 years.
Okay, and how big is the firm?
So we're happy to say 2020 was a tough year, obviously, for everyone, but we grew roughly $300 million last year. So we're close to $800 million.
Nice.
Thank you. We've got these 6 investment professionals. We've got a few other support personnel, but what we try to do is do what we do best, which is analyze companies, construct portfolios, and execute on trading. But with 15% turnover, trading isn't a huge point of differentiation. So we outsource to people such as yourselves, right? That really maintain the relationships with the direct investors. So it helps to keep our operation relatively simple.
Okay, so let's go a little bit different angle here. We're still really, for the most part, on firm structure, which is the first part of my firm CPR piece. Tell us a little bit about the length of time that you just handled direct business, and then sort of the impetus or the jump to become available on various platforms like Envestnet or our own Union UMA.
I would say there wasn't a clean break. We still manage some direct relationships, mostly because we really enjoy the relationships and we like the people. We've been with them for so long that we have really a sense of obligation to them. It's probably 5 years ago, I would say, is we really made a concerted effort to not take more direct business. And the rationale behind that, Jeff, was direct business really, it's hard for an organization like ours to scale because for any relationship that we have, we want to have a meaningful relationship. We want to be able to jump on these webinars. We want to have sponsor client events. We want to be actively involved in our partners' business and help them grow that business. And at some point, as you scale, you lose the ability to have those meaningful relationships, and the relationships become much more commoditized. So I would say it's probably been about 5 years. We really pride ourselves in understanding the ecosystem in which we play, understanding what our clients need from us in order for them to be effective with their clients, and making sure that we execute on that over and above just implementing our investment strategy.
No, that's a great answer, and frankly, it matches up with number one, it's part of the reason why our firms get along so well. But I recall the first time I met Thurman, who's the primary contact person for advisors who want to learn more. And it was just easy going. I mean, in fact, frankly, to be full transparency, right? We met in person over a beer at the down there in downtown Dallas. So it was just nice to see a group that is not focused on pitching their product nonstop, but rather, hey, you know what you do it well, and then let the chips fall where they may. One last question in this space is there a particular thing, I've asked this question before, but what's the passion that drives the action? What is it that's sort of the driving force behind Brookmont doing the fundamental work to say, okay, well, we want to have this low turnover, easy for non-qualified accounts, individual security selection, and yet you keep it at a pretty low minimum?
Yeah. There's a lot there to that question, right? One of the reasons why we like our SMA structures is because it encourages longer term strategic investors. We're approached pretty regularly about doing a non-transparent ETF or something else that's more listed and more tactically traded, which we actually agree with, and we think that's great for other investment philosophies and programs. From our standpoint, we kind of like the longer term nature of an SMA and the longer term nature of some of the relationships that we have, such as the relationship we got with Potomac, right? So that I think is a big part of the structure of the SMA. We still love individual securities. I mentioned, I think we're highly concentrated with 30 or 40 best ideas. We like to talk about how we are index aware. So we're plus or minus 5% of the Russell 1000 value, which is our primary benchmark. We have a portfolio construction discipline of no more than 20% of any given sector. I know that's all boring stuff, but I think it's instrumental in understanding sort of our approach, because we choose individual securities because we think we can still really deliver alpha by picking the best of the best within the various sectors, by sticking to our core investment philosophy, which is not just dividend paying companies, right? And one thing that we've struggled with over the last couple of years, the advent of this equity income, right? Where you've got these people that are in similar spaces as we are that are really stretching for yield in a low yield environment. They're buying BDCs, they're buying MLPs, preferred shares, because they're trying to hit some sort of an arbitrary yield target. Whereas we think individual securities, you can get a competitive yield, and we have a relative yield in our mind of 1.5% versus the broader equity market. But we really think that the yield is much more a sustainable yield is much more indicative of a longer term total return, and that's what we're looking for.
Okay, well, we've sort of let's do this. Let's go ahead and dive into a little bit more of the process and philosophy. Even though program design and philosophy comes after, is a little out of order in my CPR process. That's okay. That's okay. So help me understand this. One of the things that when I talk to advisors as an OCIO, and I start to talk about Brookmont, without going into the actual performance stuff. So help me understand, is the drawdown side something that you're actively working on, or is it just sort of a side effect of choosing the good companies based on your fundamental process?
It's more of the latter, right? And as we think about where we play from an asset allocation standpoint, we think of the world in terms of highly speculative on one end, right? And today's world, I think, is dominated by talk of cryptocurrencies, GameStops, Teslas, even some of the SPACs that are being launched, as being highly speculative in some cases. And then on the other side, you've got contractual asset classes, right? So fixed income is a great example, right? You're contractually obligated to return principal plus accrued interest, right? And where we sit is kind of in the middle, right? And we think that that middle ground from an asset allocation standpoint is one of the things that really contributes to our downside protection, right? We've got built-in inflation protection, right? So what ends up happening during periods of large drawdowns, our relative yield gaps out, right? Because the price goes down, our yield gets very, very attractive and creates really a backstop to help us achieve that 62% downside capture ratio. And so we think that we don't do a lot of active trading in the middle of a drawdown to limit our participation in that drawdown. Rather, we really use our macro backdrop of where are we in the cycle. What are we looking at from a risk allocation standpoint within our sector allocation, and let that macro positioning really drive the investment returns.
Okay, let's appreciate that. Let's dive into something else. You've recently done a name change on the two portfolios that are available to us. Can you describe a little bit about what the kind of why you went through the name change? And it's okay to go ahead and name the two portfolios, but again, I just want to help advisors understand, because this is one of the things that I end up having to answer myself.
Well, and Jeff, we did it because we believe that it is more indicative of the investment philosophy, and frankly, is easier for you and your advisors to understand and explain, right? So our core portfolio used to be called the Dividend Equity Fund, which, as I mentioned earlier, people were getting confused with equity income, right? And so then immediately people say, okay, it's dividend equity, therefore I'm buying it as a fixed income replacement, right? And that's not the case, right? So we changed the name of that fund to Dividend Growth. It's our dividend growth strategy, because ultimately, we were always looking at strong, sustainable dividends and growing dividends. And almost 50% of equity markets return over the last 100 years is attributable to dividend income, right?
Right.
So for us, it's more of one of the core reasons why you're in the equity space is that return of capital, and the growth of your capital and the ability to sustain that return of capital. Right. So dividend growth is what our legacy dividend equity fund is now called, because it's capital appreciation and dividend appreciation as well. We used to have a fund that was actually ironically called Dividend Growth, that we changed the name to Quality Growth. And that's the one place where we had a slight tweak. We never had in Dividend Growth, we never had a hurdle from a dividend distribution standpoint. But what we did there is we said, okay, we're going to take the same dividend growth philosophy from our anchor strategy, and we're going to apply it to free cash flow. And we're going to remove the requirement that they're paying a dividend today. Rather, they have the capacity and the expectation to initiate a dividend in the short term, right?
Gotcha.
And what we're trying to do there is we're saying, remember how we talked about speculative equities, right? What we're trying to differentiate is this isn't a speculative growth equity. This is a core fundamental growth equity that has free cash flows that demonstrate that it is in the short to intermediate term going to be transitioning from a pure play growth speculative play into more of a value return of capital play.
All right. Well, that is helpful. Again, advisors sometimes see something or a performance filter, or they might come across your name, and if they see any history, all of a sudden, wait a minute, they come across something that maybe has the older name, and I thought it would be good to put it on record about the name change. All right. So as we're moving forward, right, let's hit some of the basics very quickly here. Communication. Tell me a little bit about how you interact with advisors. Are there monthly newsletters? Are there everything done via email? Is there an entire sales team? Hit a little bit of that in.
So you mentioned Thurman, who is our primary liaison from an investor relations perspective. He's great. Some of it is actually market generated, right? So last year we did a lot more publishing, a lot more outreach than we would in a typical cycle because so much was going on. Okay. And one of our core mandates is to keep people in the equity markets, and that's hard to do when you see massive drawdowns and then just volatility and just fear in general, right? So part of it's market determined, but we do publish a monthly video blog. I think the kids call it a V blog or something. Yeah, Herman knows about that stuff. So we do that, and we do a bi-weekly written blog. Okay. And we do quarterly market outlooks. We actually will do write-ups on trade rationales for those advisors who. I mean, we 15% turnover. We do have the luxury of getting really deep into some of our names and providing really good trade rationales that hopefully arm you and your advisors with the tools they need to have good, meaningful conversations with their clients. And that's what we try to do. And then in some cases, people really just want the highlights and want something that's very approachable, and we're happy to provide that as well.
Excellent. All right. So I always like to ask this as the last question. What questions should we have asked?
I think what it really comes down to is focusing less on yield, focusing more on what an attractive dividend and dividend growth rate means to longer term performance. And I think your advisors should really focus on that and understand why they hold this as a strategic longer term equity investment versus a tactical, in a world that's dominated by tactical trades and thematic ETFs. This is the one sort of strategy that we think should stand the test of time and be in a portfolio throughout the entire investment cycle.
All right. Well, all right. So let's we did the important stuff. Now let's do the super important stuff. It's recommendation time. Ethan, what do you got for us today? You know the drill. I made sure you had to have a recommendation. So what do you got for us?
The recommendation that it couldn't be financial related. So, and I know, Jeff, you were just in Texas and you're in Arizona now, and we're based in Dallas. And one of the things that crawls under my skin a little bit is when you talk about ethnic food in Texas, the only thing that comes to mind is Mexican food. Okay. And there's Mexican food going on every corner, and Mexican food is just a different configuration of rice, beans, tortillas, some meat, and jalapenos, right? And I love Mexican food, but I would encourage your viewers to consider Indian food, Vietnamese food. They have tens, if not hundreds, of different spices and combinations, and each dish has a distinct role and is very thoughtful and has been in the culinary landscape for hundreds of years. Please, when you're going out for dinner, consider something other than Mexican food, and that's in particular for our Texas and Arizona friends. But I would offer that to anyone.
Yeah, well, Manish is clearly going to like your recommendation, but he's the opposite of the old Life cereal commercials and Mikey, who hates everything. Manish eats everything, so yeah, I have no doubt that he'll like your recommendation. Okay, so I'm going to throw in an old. I'm sort of in this mode recently of old throwback entertainment. And something that I liked as a kid, I remember playing with some of the toys that came out involving it, was Force 10 from Navarone. It's Harrison Ford was a lead character. Again, back in the early 70s, like, all these movies were just stacked with major actors and actresses, and it was just pretty cool. I really love that old World War II flick. So Force 10 from Navarone, that's a simple one. So if you like the throwbacks, there you go. You got another one from me. On that note, we're going to wrap it up. Certainly, we will release this, and we're excited to have others enjoy, share, give us feedback on this interview. As well, the Conquer Risk podcast on our YouTube channel is absolutely going crazy. So we appreciate all the likes, subscribes, click the ringy bell dingy thingy, whatever iteration you want to say. We appreciate that from our advisors and our field. So thank you, Ethan, for joining us, and we're out. Peace.